Hello and good afternoon. It is Saturday, and welcome to Phenom Group. Welcome to our new YouTube channel. And I wanted to take this opportunity as the weekend progresses to kind of update some of our followers and our members at Phenom Group as to how we progress throughout the trading week and what we're seeing in the weeks to come. So let's get started, and hope everybody's having a good, relaxing weekend. Hope everybody's being safe as well out there and doing what we can do so far as curtailing the epidemic spread. And with that being said, last week we got an update on from a lot of different strategists and analysts around the market community. As you can see in the chart here, let's highlight some. Cantor Fitzgerald, and these are the ones that we really care about, are of course for 2021 and their EPS estimates off to the far right side. Last week, Goldman Sachs, their chief market strategist, David Kostin, upgraded their outlook for 2021 so far as S&P 500 target and their EPS estimates, and they come to 4,300. So not too shabby. Jefferies at 3,750, 3,900 for Morgan Stanley. What is not shown here is the updated price target from JP Morgan's team. We'll get to that in a little bit, but theirs is actually, they see the S&P 500 hitting 4,500 by the end of 2021. So that's also not too shabby, especially where we sit as of the end of last week on the S&P 500 at 3,500. So to get to 4,500, that's a good 1,000 points. But we'll see. How we get there is a whole other story. Obviously, the market doesn't travel in a straight line up or down. So the S&P 500 has made 584 new all-time highs since 1990. In 2020, it's made 24 new highs alone. That's not as good as the NASDAQ, which has made, I think, 42 new highs here in 2020. Now, with respect to the S&P 500, the VIX's average on days where the S&P 500 made new highs, and again, this is going back to 1990 since that's when the VIX was created. So on days when the S&P 500 made a new high, the average VIX reading is 1464. 75 times the VIX closed. Now this is with the S&P 500 making a new high. The VIX has closed over 20 on those days. The highest VIX close on record when the S&P 500 made a new high was 2625 in the year 1999. One thing that I always highlight when I talk about the VIX and comparing it across time frames, the thing that I suggest is don't do that because you don't necessarily know what correlations, sector correlations are, during those time periods. So the VIX can look very different. I mean, we have the S&P 500 at all-time highs with the VIX still above 20. When the S&P 500 made an all-time high earlier in February this year, the VIX was at 13 or 14. So comparing it across time frames just doesn't, it's not an exercise that lends any value. That's not to say that there's not analogs that you can look at and see the likeness in the movement of the VIX over time. All right, so with that, one of the things that we finally have here as we've gotten to the other side of the election is a normal looking VIX futures term structure. And here's kind of a screenshot of where we ended up the week. We'll go to VIXCentral.com, and this is a great tool that was created by Eli Mintz. It's his website, and there you go. We've got a normal looking curve. Normal looking is when you have futures in the back months that are higher than the front month VIX futures here. And that's a state of contango where we have 5.68% contango right now. One of the things that I tend to say, and we are very early in this VIX futures calendar cycle for the December month, when you have a roll yield this wide, see all these contracts here, all these later dated contracts here are a pretty good distance from the VIX itself, $2 or greater. And this early in the December futures contract, what I like to say is that the VIX futures are saying, no, you're lying to me, VIX. There's no way you're staying down there, and that's why we're all the way up here. More often than not, VIX futures are wrong when they are saying that, because more often than not, the VIX is relatively stable and somewhat moving in a complacent direction toward its mode. There's a comment saying that the VIX is a mean reverting instrument. The reality is it's a misnomer. The VIX is actually a mode reverting instrument. It spends more time at its mode reading than it does its mean reading, which is around 16 for the mean. The mode is between 12 and 13. Going back to 1990, the mode is around 12 and a half. So that's why I say between 12 and 13. It spends the majority of its time down there at about 12 and a half. So it's a mode reverting instrument, but it's become so commonplace that people think that's the law, that it's a mean reverting instrument. Anyways, long story short, we do have, normal looking futures curve, and we haven't seen this in a bit of time. We used to have this bump there in the back month contract, and now it's just a normal looking curve. Having said that, it's a very flat curve. If we change the view from wide to narrow, you can see there's very little price difference from M2 or month 2 to the far dated contract. Very little price differential. Very flat, except obviously at the front end of the curve. So it's a nice look here quickly at VIX futures term structure. The rate of change in 2020 has been abnormal, to put it mildly, as we look at history. And then what I mean by the rate of change is how many 1% days that we're moving in the S&P 500. How often is the S&P 500 moving 1% for that particular day? On average, let's go back a 35-year history now. The S&P 500 has 65 days annually where the close over close, so the day-to-day, is plus or minus 1%. Thus far in 2020, there have been 103 daily moves of more than 1%. So it's been a very volatile year. As you can see here from this chart, and this chart is as of July. So it's not quite all the way up to where it should be, right here above 100. For 2020, 1% days, 1% days. But you can see the highest amount of 1% days was in 2008. 2008 at about 135 days, where the S&P 500 moved 1% or more on a day-over-day basis. And the very next year, in 2009, about 118 days. So we've got 6 more weeks left in the trading year. We can still set a record here in 2020, folks. We can still see a record. Right now we're at 103. We've got to get to about 135. It can happen. It's unlikely, but you never know with this market in 2020. When I look at the VIX 2009 analog, because the VIX has been following 2009 very well. I pull up the chart here from January 21st to December 31st of 2009. If we just kind of, fast forward to, the 20th. On the 20th, the VIX closed at 2219. Now, intraday on Friday, on the 20th of this year, it almost got to 2219. almost got there. It closed, though, with an uptick in that last hour of trading where the markets kind of rolled over. You can see it closed at 23.70, but intraday it almost got to 22.19. So it's very much mirroring what we saw in 2009. And if it continues to mirror that, we might expect more upside here, possibly to intraday on the 27th, 25.75. Now, it's not going to be on the same day and what have you. It could be a day later, it could be a day sooner, but we should expect, because this analog has been so tight with 2020, we should expect some kind of an uptick in volatility near term. If it doesn't come to pass, it doesn't come to pass. But the purpose of these exercises is really to get an expectation, so that you know what you might see in the future. Because again, this has been very tight. And the same thing with the S&P 500 has followed almost perfectly the 2009 S&P 500 path. Again, we'll get to that in a little bit as well. This chart right here, I love. We're going into this period of a little bit more uncertainty in the market, and it's hard to even say that with a straight face, seeing how we just came through a rather uncertain period with the 2020 election, which is still going through its machinations, if you will, of fully declaring and certifying the victor, the next president, Joe Biden, elect President Joe Biden. But there's still legal maneuvers that are being purported by the incumbent at this time. So with that said, again, think long term. I always encourage investors to think long term. This brief period of uncertainty, whether it's related to the election, the infection rate and hospitalization rate of COVID-19, this is a very brief period of time that we're going to be entering over the next 6 weeks, whereby you could see a very choppy S&P 500, a very choppy NASDAQ, a little bit more volatility. But the window for which we can consolidate the year-to-date gains is narrowing, because we have answers for some of these, pretty much both of these issues, the election and COVID. We have a scientific answer to COVID-19 in the way of a Pfizer and Moderna vaccine. Pfizer filed for their FDA emergency approval as of Friday. More than likely, at least in my opinion, I think we get that FDA approval next week, if not just after the Thanksgiving holiday, the following week. And then when it comes to the election, the certification process is within a couple of weeks as well. That all butts up against the budget. Congress has to pass a budget. Then that may get into, you might see the intermingling of a fiscal package that kind of rides the coattails of the need to pass a congressional budget. So again, things can get really choppy, but the window, for which we can consolidate these price gains in the S&P 500 is rather narrow. And so if we just think beyond that as investors, if we think beyond these next 6 weeks and we start focusing our portfolios as to how we want to position going into 2021, where we have greater certainty, where we've overcome some of these headwinds, if you will, investors should be looking at greener pastures. So any choppiness, any drawdowns in the markets should be viewed, in my opinion, as opportunity. Why? Because the market is generally moving from as I always say, the lower left-hand corner to the upper right-hand corner. The market is generally higher over time, setting new highs at a rather consistent clip. And excuse me. And what this chart here basically signifies is the percentage that the S&P 500 is up on an annual basis. It's usually going back to 1928. So 91 years up to 2019. This will be the 92nd year. The market is up 77% of the time. You want to be long the market. You want to be buying dips. You want to be increasing your portfolio exposure to the market, year after year after year. Drawdowns in the market are a normal part of any year. The average drawdown in the S&P 500 for any given year is about 13, 14%. It's normal, to be expected, as they say. But 77% of the time, the market is higher. And this graph depicts that the market is up 0 to 10% about 20% of the time on any given year. The market is up 10 to 20% almost 19% of the time. The market is up 20 to 30% on any given year, 23% of the time. We just came off in 2019. In 2019, the total return was almost 31%. Historically, when you've had a 30% or higher annual return, going back to, let's say, the World War II era, so going back to World War II, the next year, the S&P 500 is up double digits. We're up about 10% this year. So we're falling in line again with the historic data. Historic data is your friend, it's your guide. You want to, position alongside the greatest probabilities. And that's also why we, highlight this chart right here, is it shows us the greatest probabilities. The greatest probability is that 77% of the time, the market will be higher for any given year. And why do you want to be long equities? As maybe my father would always say, if you find that there is a greater demand for an ever decreasing supply of that good or service, you want to own those goods or those services. And the S&P 500 finds itself with ever decreasing shares. And that's what this chart right here depicts. This is the S&P 500 total shares outstanding. And as you can see, it's been on a downward trajectory ever since pretty much 2010. More than likely, when Q3 updates for this chart, it's also going to show another decline. And this is in a year where we've had a lot of new issuances. A lot of companies have had to raise capital. They've issued more stock. But even so, long term, this is where you want to align yourself. If you're an index investor, if you're a sector investor, know the sectors that are also finding themselves with this same type of chart pattern, a decreasing supply of shares and an increasing demand. Technology is just one of those sectors where it looks just like this. You have, that's the XLK, the technology sector ETF, decreasing supply of shares, increasing demand year after year. You want to be an owner of the market. You want to be long the market. If we consider the post-pandemic 2021 period, I would be of the opinion there is a bullish backdrop that will further curtail, shares going forward. So speaking of the technical, we've been talking about breadth in the market for several weeks with phenomgroup.com members. It's something that we focus on in each one of our weekly research reports. It's one thing to look at the S&P 500, which is a cap-weighted index, and say it's moving higher. It's a whole other exercise to look underneath the hood of the S&P 500 and know whether it's just a handful of stocks that are helping to move the S&P in that direction, or if it's a wide swath of stocks that are moving up, with the cap-weighted index. So we look at breadth. We look underneath the surface. We look at advanced decline lines. We look at how many stocks within the S&P 500 are trading above their 50, their 200, their 20-day moving averages. And folks, they have gotten to levels they haven't seen in a long time. I mean, breadth has been so strong that it begged the question, is breadth too strong? And usually when you see the readings that we've seen where some 90% of S&P 500 stocks were trading above their 200-day moving average. Some 80% of stocks were trading above their 20-day moving average. Those are breadth readings that signal the probability that you're putting in an interim top whereby folks are going to start locking in profits, and more than likely you're going to see a pullback in the major averages. And we think that's healthy. We think that a normal consolidation of overheated conditions is healthy. It allows for, well, cash on the sidelines, to buy into this market. But in speaking of, technicals, many investors avoid technical analysis. They think it's a difficult discipline. It's not terribly difficult if I'm being honest. And I'm not a technician. I'm definitely not a certified technician. But, over my 22-year career, I've done a lot of, technical analysis. I've learned how to perform technical analysis. I've learned the terminologies. I've learned, what is more relevant. And speaking of what's most relevant, even to the novice investor and new to technical analysis, this phrasing here in the highlight, it says uptrend. What's an uptrend? Well, it equals higher highs, higher lows above rising moving averages. So if what you want to see is like the 50-day moving average moving up, the 200-day moving average moving up, the 100-day moving average moving up. That's rising moving averages. You want to see higher highs, higher lows above those rising moving averages. That's an uptrend. What's a downtrend? A downtrend is lower highs and lower lows below declining moving averages. Determine your time frame, obviously, but that's really the extent of technical analysis most people will ever use. Even your most complex and ardent technical analyst will say, this is it. This is really all you need to know to understand whether or not you're in an uptrend or in a downtrend, and make your decisions so far as capital allocation based on that. Everything else is a bit more nuanced and kind of superfluous when it comes to the indexes. Individual stocks, you could get into the weeds and you could broaden out your technical analysis, but ideally, even with individual stocks and sector ETFs, higher highs, higher lows, you're in an uptrend, and you probably want to stick with that ETF or that stock for that matter. Now, again, breadth has been really strong, folks, and that's what these charts signify here. When market breadth as firm as it has been in recent weeks, investors should keep in mind that these are usually the type of breadth readings that produce drawdowns. So again, expectations. This is why you do this kind of research. This is why you, spend some time performing due diligence, whether it's fundamental analysis or technical analysis. It's to have your trader and investor psychology establishing appropriate expectations for the coming week or coming weeks. So you're not reacting so much to the in-the-moment price action. This is a great chart here. It looks at breadth in 2-year periods. This is from Ari Wald of Oppenheimer, very well-known technical analyst. He's on Bloomberg a lot of times. And he says the percentage of New York Stock Exchange stocks above their 200-day average peaked at 82% last week, its highest tally since May 13th. Price leads breadth. That's, again, when it comes to breadth analysis, when breadth is good, when it's making new highs, even relative new highs, after a really a trough point in the market, a trough point in market breadth, you want to see, higher highs in market breadth, like the NYSE advanced decline line and how many stocks are trading above a particular moving average. The point of Ari's chart right here that we're looking at is very simple. And I'll repeat, breadth leads price. What is most important is maintaining the appropriate market expectations and having a designated game plan for when markets consolidate. The bottom line here is that breadth has peaked 2 years ahead. Breadth has peaked 2 years ahead of price in the prior 2 cycles. Here's the S&P 500, folks. Breadth peaked here. The market kept rising for 2 years. Breadth peaked here again. The market kept rising for 2 years. Breadth may be peaking again here. We could find ourselves rising over the next 2 years. And according to the chart that we saw before of the updated S&P 500 price targets from the analyst and strategist community, that is what we should see. Higher prices at least out into 2021, but according to history, the next 2 years we should see S&P 500 with higher prices. Now we're going into Thanksgiving week. How does the market trade, that week of Thanksgiving? And this is a great study performed by Schaefer Analytics. And it shows you going back 50 years during the week of Thanksgiving, average return right there, 0.59%. It's not, it's nothing fantastic, but it's nothing to shake your fist at either. And they break it down by day. Again, 50 years, average return on the Monday, 0.07, nothing. Tuesday, 0.01 negative, nothing. But then on Wednesday and Friday, that's where most of the gains come from. And it serves to figure because you got a lot of last minute shopping there. On Friday, there's a lot of just, positive vibes around Thanksgiving. And then, of course, you've got Black Friday, the day after Thanksgiving. You get all the headlines on, all the news networks and the lines outside of stores. And this is going to be a great holiday season. And again, that's just positive sentiment that feeds through the equity market. So really good study. Just, again, setting expectations for next week. Knowing your historic data can help with that. Talked about the 2009 analog, and here's your chart, folks. This has been our guide at Phenom Group pretty much since the bottom in March. And as you can see, bottomed in March in this year, bottomed in March of 2009. As of Friday's close, this year, 2020, the market was up 60.1% off the lows. And in 2009, at this point, the market was up 61.8%. We're only about 1.8%, trailing the 2009 analog. We're on the same path. But again, as I said early on, I'm expecting some choppy action, and that's exactly what we got in 2009 over the next 4 weeks or so, and we didn't finally lift off until like the final week of December. Expectations. This has been just a beautiful analog. It's played out almost a mirror image. It's been the guide until it's proven wrong. Yeah, but we didn't have COVID and we didn't have an election in 2009. The circumstances are always different. The one thing that is pretty constant, though, is human behavior, regardless of the circumstances. And that essentially is what the market displays. It's an expression of human behavior, despite the different circumstances. Kind of a boring last couple of weeks, right? In the market, nothing's really happened. Last 15 trading days of the NASDAQ and S&P 500, just consolidation. For both time and price, consolidation. Again, it's perfectly acceptable. It's healthy. With markets at new highs, knee-jerk reactions will be more commonplace. These cooling off periods are a welcome pause that helps to kind of eliminate that excess in the market, frothy valuations, if you will. You want this type of consolidation. COVID restrictions rolling out around the nation, affecting possibly GDP in the fourth quarter, affecting overall economic activity. Haven't really seen it show up in any material way just yet. This is a look at both the Bespoke Investment Group and the New York Weekly Economic Index, New York Fed Weekly Economic Index. They're still both moving up. And the New York Fed's Weekly Economic Index is an index of high frequency data. It's Red Book retail sales, it's hotel vacancy rates, it's TSA check-ins, it's all that kind of stuff. Open table, dining reservations, a lot of that under the radar stuff that you get the data for pretty much every week. And even though we have these rolling restrictions around the country, so far the economic activity has held up based on both Bespoke Investment Group and the New York Fed's weekly economic index. Now, it could get worse. And quite frankly, at Phenom Group, we expect a soft patch here over the next several weeks, as it doesn't appear we're getting the infection rate under control. And we see, every week that there are more and more counties and even states rolling out or reimposing economic restrictions amongst the population. So JP Morgan, that said we get to JP Morgan's $4,500 price target for 2021 in a minute. And this is their chief U.S. equity strategist. These are his notes here. And as you can see, what he says is, we highlight expectations of many key risks subsiding, clearing the path to a more positive forward outlook with an S&P 500 target of 4,000 for early 2021. What's early 2020? That generally means the first half of 2021. And 4,500 by year end. Pretty good. Pretty good. What's it going to take to get there? Earnings. That's what it's always going to take. They, talk about, earnings there. We had Morgan Stanley earlier in the week that was raise their earnings expectations to upwards of, from 175 to their best outlook of 195 in their bull case. So I wouldn't be surprised if we do see something in the 180s, which would be a record high for S&P 500 EPS. Back in 2019, it was roughly $168. So we're looking at a very quick rebound. I remember back in April, folks didn't think, the strategists and analyst community didn't think we'd get back to 168 until 2022. Now we're talking well above the former highs of $168 in S&P 500 earnings. Some really good stuff here from JP Morgan's Michael Semblis, watching kind of the perma bear crowd. Your David Levy's of the world, your Carl Icahns, your George Soros, David Stockman, Peter Schiff, Mark Faber, David Rosenberg, Jeffrey Gundlach, Nouriel Roubini. Basically, if you took $1 out of the S&P 500 and put it in a bond fund, you would have lost money based on their commentary and their fear mongering, if you will. So a lot of good commentary in here. Hope you check it out. We compile all of this. We put it in a link on phenomgroup.com so our readers can view all the notes for free. So just kind of an update here on where we stand going into next trading week. Again, another look really quickly here at VIX futures term structure. As I said, I would expect a bit more consolidation of the gains, test that $3,500 level, and see what kind of bull bear battle ensues at that level. If we can hold there, right now we are setting up kind of a bull flag in the S&P 500 if we are going to talk technicals. And if we can hold that 3,500, more than likely we're going to march higher and possibly get to 3,700 by year end. Not in a straight line. I'm expecting choppy action. And if we do break below 3,500, as I said, you got to kind of think about your portfolio in terms of 2021. Weakness in the market, lower prices, cheaper valuation is your opportunity for 2021. Got to look beyond the here and now. With that said, I'm Seth Golden. Please check us out at Phenom Group. If you like our content, please subscribe to our YouTube channel.